Welcome to this tutorial on Fibonacci Trading Strategy that helps you to find the best place to exit your trades. I often hear people struggling with where to get into their trades. I actually find that very easy. I have no problem with that. That's actually one of my specialties, and I'll be happy to share that with you as well on another video. But today's video is about where to get out. And this one I find is much more challenging for more traders. In fact, even a lot of veteran traders that I talk to and some who are retired say that they never really mastered exactly when to get out of a trade. So I'm going to give you some help with that using Fibonacci extensions, and we'll throw a little else in there too. But we got to keep this video under 10 minutes, so let's get right to it. All right, so as I said, we're going to use the Fibonacci extension tool as our primary tool for determining where to get out. Now, when you do this, actually, let me go back here and turn that off. Whoops, there we go. That's great. Okay, so let's talk about how to draw this thing correctly. So you can do it many different ways because Fibonacci ratios are all relative, but the most traditional way, and the way that I personally like to do it as well, is to take a low, the lowest low, and as you start making an up move, then go from the lowest low to that high, and then down to the higher low. So what we're doing is we're starting with a new impulse move, a reversal if you will, because we've been going down for a long time. So then what we do is we use, it's a 3-point drawing tool, as you saw there. If you didn't catch it, just review. You can rewind here, the beauty of video. So we use the lowest low after we move down, and then we go to the next high. Usually it'll be a little bit of a higher high than the previous swing high. That doesn't necessarily have to be, but it is actually good if it is. And then the higher low, the first higher low of that reversal. So those are the 3 points, 1, 2, 3. Then instead of measuring Fibonacci retracement levels, which would be below this high, it actually draws levels above it. And so it is drawing targets. So now we're going long, we're looking for longs, and we're looking for potential profit targets, price levels where we might want to take profits. So let's look at how well this works. So the first thing is, and by the way, not every level is going to provide a place where the market stops and turns around or puts in a high or a wave or a cycle, but a lot of them do. So the first one that we always look at, or that I look at, is the 100%. That's called the measured move. And it's quite often significant, but look, this time, hey, let's just call it what it is. The market didn't even acknowledge it. It just sliced right through it and pretended like it wasn't even there. Now it hesitates at the 150, but it really finds its high at the 200%. And what that literally means, the 200% means that from this level here, if we were to draw just this horizontal line from here and then go up, okay, that's your initial impulse move to the upside. So you take that and double it, and that would be your 200% move. 100% would be the same length of that move. So that definitely provided some resistance there. Let's try to keep our charts neat here. So that is the place where we first get real significant resistance. Then it comes back down, and where do we find our support? At the 150. So sure enough, these two levels work quite nicely. Goes back up to 200 and has a little trouble there. So basically what's happening is the market participants are aware of this high and are a little uncertain as to whether there's going to be more buying traction, because let's face it, the market already moved up 200% of the initial impulse move. So a little harder for it to continue going. The mass psychology behind that is that people are just wondering if this is getting to be overbought now, if there's too many people already on board, are there enough buyers to come in and continue the market move up. So a little hesitation there, market goes down 3 bars, and then market decides, yep, we believe it is. Again, it slices through 300, but now this is something that you'll see often with support resistance levels. If it gets real aggressive, like it does here, then it will kind of, and it has to be an aggressive move like this, a very sharp angle, What'll happen is it'll often then kind of retrace a little bit, or even just go sideways and pause, because the market starts to see, oh, you know what, that was such an impulsive move. Maybe we got a little emotional, a little too much irrational exuberance, as Alan Greenspan called it. And you'll see that kind of thing a lot. So look for that when you get these strong impulse moves. Same thing that happened here. Very strong vertical move, and then the market comes back to acknowledge the 150 because it sliced through it and comes back to acknowledge the 150. And again, it's an uncertainty thing of people saying, wow, there was a lot of energy there and maybe too much. And then we come back up and we get up to, there we go, all the way back up to 500, and we put in a wave 7. Now that's an extended move. Counting waves the way that I do it, normally you'll get a wave 5. Wave 5 is the average, but it can go more than that. So I'm not using Elliott waves. I use, well, I humorously call them Berry waves. It's basically higher highs and higher lows, but the high has to also close above the previous high, so that it's showing some commitment over there. So that's the average trend, but it can go further. We don't limit the structure to 5 waves like Elliott waves does. And it really doesn't, let's just face facts, really doesn't come into a Fibonacci extension line here. But then it does come back down. Where does it find support? Find support at the 400, which it really, again, just blew through. So here we're seeing the same dynamic. It blew through 400, did not acknowledge it. And then the market's like, oh, maybe that was a little too aggressive, so it comes back and acknowledges that level. And then it goes up to the 500% level and comes back down off of that. So these levels do work. Again, the difference between Fibonacci retracements and extensions are that Fibonacci retracements are generally considered entry points, buy points, sell points, where you get into the market. Not always, they're a little more flexible than that, but that's a general truth. Whereas Fibonacci extensions like this, that are marking levels above wherever price currently is on the hard red edge of the screen, those are considered potential profit zones. Now, they don't work by themselves. You've got to put in other things with them. So momentum, a trend is a given, obviously. The other important thing, though, is cycles, because price alone, price levels, they're very important. As we've seen, though, sometimes they work, sometimes they don't. They do work a lot, so they are important to see. But the other thing you absolutely critically need is time. So what I mean by that is, there's 2 axes on the chart. Over here we have price, and that's fine. And that's what these Fibonacci extension lines are, is they are price levels. But that is only half the picture. The other half of the picture on a chart is what? Is time. So we got price over there. Let me move my chart up a little bit here so you can see time. And down here, I mean, it's a 2-dimensional object, right? And so here we have time. And very few people actually talk much about time. What's the optimal time to get into the market? Was that the optimal time? Well, this was the perfect optimal time right here. I mean, it marks our wave lows and so forth. And then what you want to see for an exit, since we're talking really specifically about exits today, is you want to see the confluence of time, or I'm sorry, price here, with some sort of timing indication that, okay, we've got the confluence of time and price. WD Gam talked about that all the time. And that's where the magic lies. So price levels are just half the picture. You have to then incorporate with that also a timing tool. So if you're interested in the timing tool I use, we're almost done here. We're already 9 minutes into this 10-minute video. I'll be happy to make that available to you. It's more than I can share in 10 minutes, and we keep all these videos to 10 minutes. But I have a free webinar where I offer that and give you the indicator and how to use it, and give you a nice, it's about a 30 to 45 minute tutorial on how to use it. Setting up the indicator is real easy, works on any chart, but any charting software. But how to trade it is a little more, it's not hard, but it's not intuitive on how to do it. So I give you a tutorial, and that's all free. So feel free to just send me an email, barry@topdogtrading.com, and I'll send you information on when the next webinar is for that. If, well, if we're still offering it. I don't know. These videos stay up for years, so by the time you see this video, I mean, no longer be offering it. But send an email anyway to check it out. All right, well, if you like this video, please understand that, sure, it's free, and take it with my blessing. It's my gift to you. But if you got value from it, you actually do have a moral obligation to pay it forward by clicking on the share button below. That's the best thing you can do to share it with others. Pay it forward, if you will. Now, if you're watching this on YouTube, the easy thing to do, of course, is click the thumbs up icon below, and then the next level is leave a comment. I love your comments. I love responding to them, and tell me what you thought of it, and maybe requests for other videos you want me to do. That really encourages me. I love having the sense of community, and when I get that sense of community, when I get feedback from you, it encourages me to keep putting out tutorials out there for you. Now, I also want to share with you another freebie, giving away a lot of freebies today. It's my rubber band trade. And this rubber band trade has a very, very high win-loss ratio, and I give you all the rules for it so that you can start trading it right away. I encourage you to obviously paper trade it or simulate test it first. But I can teach you this trade in about 26 short minutes. I've got another video that does that, and you can get that video absolutely free by just clicking on the image in the top left corner, or if you're on a mobile device, click on the little eye with the circle around it in the top right corner of this video. And if you're not watching this on YouTube, then there's probably a link below or an opt-in form on the side. Anyway, however you request it, any of those choices, I will personally email the video to you with my very famous and very successful rubber band trade strategy.